right, I'm going to share with you my top 9 growth stocks to buy right now in July. And I'm going to reveal the stocks less than 2 minutes into the video. So I'm not going to make you wait all the way to the end to reveal those stocks. But in addition to revealing what my top 9 growth stocks to buy right now are, I'm going to explain and elaborate the factors that lead me to like these stocks at current valuations. I'm going to discuss those in a little bit of detail, not too much detail because that would require a much longer video. But I'll discuss those and then I'll also reveal the performance of these growth stocks. I'll let you know how my portfolio of growth stocks has performed against the S&P 500 and against the equal-weighted index to share with you my performance so far in 2024. So without further ado, let's take a look at the 9 growth stocks I have rated as the top growth stocks to buy right now. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Alright, so here are my top 9 growth stocks to buy right now. They include Nvidia, Amazon, Snap, Fiverr, PayPal, Salesforce, Uber, Alphabet, and Chewy. And these are the 9 growth stocks I have rated as my top 9 growth stocks to buy. Now, some of them I've had it on the list all year long. Others, like Chewy, I added recently. In fact, I added Chewy stock. March 1st is when I added Chewy stock to my list of top growth stocks to buy. And Chewy stock is up 41% since I made that upgrade into my list of top stocks to buy, top growth stocks to buy in March. So the Chewy recommendation, the timing on that has been really fortuitous, especially as it's become known as now a meme stock, and that's helped lift and bring more attention to Chewy, although the valuation has not increased by all that much since it became a meme stock. You see that big jump there and then a big drawdown. That's not a reason why I've had it on my list of top growth stocks to buy. Now, one thing you'll notice with my list of top growth stocks to buy is their relatively inexpensive valuations. The most expensive stock on my list here is Snap at a forward PE of 37. And I guess I'll start here on why I like the stocks I'm recommending here. So I'll do them collectively here. So Snap and Alphabet. These are 2 companies that generate significant sums of revenue through advertising. I'm bullish on the advertising industry longer term, even more bullish on the digital advertising industry longer term. Marketers are allocating increasing share of their budgets to digital advertising. Snap, I like because of its relatively younger user base. It skews much younger than any of the other social media apps, and it's got hundreds of millions of daily active users. Management has improved profitability. Cash flow is solid. I like that business model. Similarly, I like Alphabet because of its dominating position in the advertising industry. Again, like I mentioned, bullish on the advertising industry overall and Alphabet's market share and market dominance in that industry. So those are the reasons why I like Snap and Alphabet. So the next pairing I want to discuss is Fiverr and Uber. Now, Fiverr and Uber both employ that asset-light business model, that platform business model that I'm attracted to. I like these asset-light business models because more of those profits can be sent back to shareholders via dividends or share buybacks in the case of these 2 companies. As they grow, as their cash flow expands, more of that can be returned to shareholders, thereby increasing earnings per share by reducing the number of shares outstanding. Also, these 2 companies have grown to a significant size, sufficient to command a network effect in their respective fields. Uber has become a verb, right? You Uber it, and that's generating because of the number of millions of users that use Uber's food delivery app and the ride sharing app. Surprisingly, they've both done well as economies have reopened. Fiverr is trading at a very cheap valuation, forward PE of 8.8. There's a lot of fears of how artificial intelligence is going to hurt the gig economy, and I think those are overblown. I think there will be impact, but I think the impact will be bifurcated, meaning it won't be an overall decrease. I think it'll be a decrease in some categories and an increase in other categories. And I think there will be an offsetting impact, leaving the gig economy relatively flat overall. And that's what I've heard from the management teams of Fiverr and Upwork as well. The next pairing I want to discuss is Amazon and PayPal. So Amazon and PayPal are both benefiting from consumer behavior normalizing. So if we zoom out in the last 5 years, consumer behavior has gone through some unprecedented changes. First, with the lockdowns, people spent an enormous sum of money online because they were not allowed to spend money in person. As economies reopened, those behaviors shifted. People unleashed pent-up demand for away-from-home experiences, and that was bad news for Amazon and PayPal. Amazon, obviously, online spending, right? E-commerce, of course. PayPal, less obviously, because PayPal benefits when consumers are spending more money online. Its app is more helpful, its account is more helpful to people that are shopping online. It's more convenient for people shopping online. There's really no advantage for PayPal when you're shopping in person. It doesn't have any distinct advantage. So when people are shopping in person, there's really no reason to have PayPal, or relatively little reason why PayPal is any better than any other company. But when you're shopping online and you have a PayPal account, it adds convenience because you can just one-click log into PayPal and pay for whatever it is that you're buying instead of having to take out your credit card and type in all that information on a new site. So there's its advantage. So now that consumer behavior is normalizing, these two will benefit from that trend. Additionally, within the business, they are strongly profitable and trading at relatively cheap valuations. 34.43 forward PE for Amazon, forward PE of just 12.62 for PayPal. So good valuations, and the macroeconomic factors, consumer behavior, working in each of their favor. And I also need to discuss Nvidia, trading at a forward PE of 34.64. Nvidia has been on my list of top growth stocks to buy all year long, and despite the stock price increase, the valuation hasn't increased by all that much throughout the year. Nvidia started the year trading at a forward PE of around 28, and it's now trading at a forward PE of 34. So the forward PE valuation hasn't increased anywhere near where the stock price has increased, thereby keeping it on my list of top stocks to buy. And finally, Salesforce. The company has pivoted to artificial intelligence, employing its enterprise resource management system and artificial intelligence to help enterprises connect with consumers. And that's been increasingly looked out for now that businesses are not afraid of a recession as much as they were in 2023. And remember, in early 2023, Salesforce cut thousands of jobs, and that's boosted profitability for the business overall. And it's not trading expensively. It's relatively cheap, actually, at a forward PE of just 23. So finally, Chewy, forward PE of 23.94. Chewy, one of those companies, benefited significantly during the pandemic as online shopping increased. It's an online pet retailer. Coming into this year, management was pessimistic about the overall market, but I thought management was being overly pessimistic. I thought the economy and people spending on pets, the humanization of pets, would lead to continued growth in the business, and it turns out to be the case. After the first quarter, Chewy upgraded its outlook for the rest of the year, becoming more optimistic, and the stock price has responded. The company's management has done a good job improving efficiencies in the business, getting better at logistics and fulfillment, which is a critical part of the company's business, and that's boosted profitability and cash flow. So now that I've highlighted all of these growth stocks, my top 9 growth stocks. Let me share with you how they've performed so far. So year to date, here's the performance of the 9 growth stocks. Nvidia, obviously the best performer at 151% return year to date so far in 2024. Others have done well. Alphabet at 31%, Amazon at 29.79%, and the worst performer at Fiverr with negative 18.37%. Now, if I were to compare with the S&P 500 ETF, the total return is 15.45%, but I feel the equal weight index is more comparable to my list of stocks because I don't overweight any of my stocks based on market cap, whereas the S&P 500 index does overweight higher market cap stocks. So that would mean if I were to employ the same process, that would mean I place greater weight on Nvidia, Amazon, and Alphabet, which are my best performing stocks in my list at 150, 29, and 31%. And I would underweight the smaller companies like Fiverr, which is my worst performing stock at negative 18.37%. So comparing to the equal weight index, I think is more comparable to my comparison and the way I've returned the list of growth stocks here. So at 4.12%, you can see my portfolio has returned 21.73% year to date in 2024. Even if you compare it to the S&P 500, I'm outperforming, these growth stocks are outperforming the S&P 500 index by a meaningful sum, 21.73 to 15.45. But if you compare it to the equal weight index at just 4.12, my group of 9 growth stocks has meaningfully outperformed nearly 5x the equal weight index. But as I've said throughout the year, I would not expect to continue outperforming the index by this magnitude for a long period of time. Maybe for a few months, maybe for half a year, maybe for 1 year, maybe even for 2 years, but longer term, I'm not confident that I will outperform the S&P 500 index by this magnitude or outperform the equal weight index by this magnitude. I think that would be unrealistic to expect that. I think there will be a mean reversion to the equal weight index over the longer term. I think either the equal weight index will outperform the rest of the year, meaning its performance will be really strong, or my group of stocks will come down to match closer with the equal weight index. Why do I say all of this? Because I don't want my viewers to start to become over-reliant on my stock recommendations and my stock picks. I don't want you to gain too much confidence in these early results and think to yourself, oh my goodness, every stock that Parkev recommends is going to outperform, so let me go out and buy everything he's recommending because clearly he knows what he's doing and clearly he's outperforming and this is going to continue, so let me just go ahead and go with his picks. That's what I want you to avoid. I don't want you to jump to that conclusion. I just share this with you for informational purposes. I want everyone to follow through and do their own due diligence before picking any stocks to buy. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.